My goal for this Periscope is really to discuss some of the common mistakes I see people making. I have a lot of followers on Twitter, and I get a lot of people message me. Unfortunately, they usually message me when things are a little too late in trades, when they're in trouble. But I've been noticing a common theme on the stream and also in the DMs that I get. And the common mistake that I get is how people don't really understand options or how to use them properly. And I'm going to try and shed some light from my knowledge of options. I'll tell you, when I was in college, I studied a little bit of options. I did very well on exams with regard to options, but I didn't really know them. You don't really know them till you trade them. And once you start trading and getting more familiar with them, it becomes, I guess, it's sort of like driving a car, a stick shift car. You start getting the feel for things a little bit better. And the thing that I think is that I find the most problematic is that people don't really know what they are, as far as what they're intended to do. And I see most people making a couple of very common mistakes, so let's go through them. First and foremost, you must understand how options are priced. They are priced on what's known as the Black-Scholes option pricing model. There are some other ones that are used, but that's really the one that that is relevant for this conversation. And within that, to keep it simple, stupid, I always like to keep things really simple, particularly for Periscope, is the Greeks. There's the delta, the gamma, the theta, and the vega. And I think that the lack of understanding of these Greeks is causing a lot of losses. First and foremost, the time horizon. I find that the mistake is people are buying weekly options that expire the same week. Weekly premium. My beef with weekly premium are twofold. One is that you're paying basically, and they're also buying out of the money. That's also, it's sort of like flyers, lotto tickets, if you will. And if you ever go into a deli and you do scratch-offs or you play lotto, you realize that you lose more than you win. Everyone, of course, there has to be a big jackpot winner, and those will happen once in a while. If you play all the time, you'll have a couple of winning tickets. But over the balance of the time, if you keep playing and playing, you're going to wind up being a loser over time. And the reason is this, is that you're assuming two things. One, that you have direction, and the time frame in which that directional move is going to happen immediately, pretty much when you buy your options. Those decay, as far as the premium that you pay for those options. There's two parts of an option pricing. Obviously, intrinsic value, which is, if the option is out of the money or in the money, and then there's just time value. And if you're buying out of the money options, it's pure time value. So you're assuming you're going to get your move immediately. You have theta decay, which is time decay. That's one of those Greeks that I talked about. And if you're not right immediately, the time decay, meaning the amount of that premium, is going to erode quicker and quicker as the week wears on. Usually after Wednesday morning is really when they start, really, the erosion kicks in tremendously. It's also assuming that your risk is, like I said, the theta and then also the gamma, which is the kind of the first derivative of the beta. So let's just go through the Greeks first and foremost. Of your delta. Your delta is the amount of money that you will get for every point move in the option. So if you have a 50, or let's just take something really out of the money. Let's say you're playing Tesla options. Because I just happen to have that open on my screen, and you're in the 2 DTE. You're paying. Let's just look at the 240s, for example. The delta on that is 12 cents, meaning for every dollar up the stock moves, assuming it moves up, you're only getting 12 cents. And for that right, you'd be paying about a dollar, 47.5 cents. That's the midpoint. I'm just going to use that. So you have to get up to 240 plus your 47 cents, even to theoretically break even. Of course, if there's like a huge move and Tesla goes to 260, you know, this is all, you know, a ridiculous conversation, but the expected move this week is only $7.71. Keep that in mind. How do you calculate that? You calculate the at-the-money strangle and just out of the, at-the-money straddle and just out of the money strangle. If you're in Thinkorswim platform at the end of every option, plus commissions, of course, if you're at the end of the options chain, you can see that they have the plus or minus there. And it's very useful rather than having to go in and calculate it, although I know not everyone uses TOS. So that's your issue. If you're right there, let's say you're playing the day of or what have you, or as you wind down toward the expiration, you have basically 100, I wouldn't say 100%, but increasingly large percentage of gamma risk. And gamma is just the amount that the delta moves for every point up. So for our example of the Tesla 240 is 2 DTE, there was a 12 delta and then there's a 2 gamma, meaning after that dollar rise, the delta will rise by 2 cents as well. And so on and so forth. Those numbers are changing as you get closer and closer to target. However, the theta burn for each day is 30 cents. So out of the expected, out of the premium that you're paying of 47.5 cents, as of the close tomorrow, assuming no move up or down, 30 cents of that is gone. Poof. Gone. So that to me is the mistake. People are really gambling in their options, and that's some of the big losses that I hear about. I think that the better way to play with options, first and foremost, is if you don't know what I was just talking about with the Greeks, the gamma, if that was Greek to you, you have no business touching options. It's like being handed a grenade launcher, and I know a lot of people are going to say this example is extreme, but I assure you, I've seen too many blown up accounts I can't emphasize this enough. It's like handing someone a grenade launcher and saying, go play. Sure, you know how to pull the trigger, but you don't know how to aim, you don't know how to reload, you don't know how to maintain the thing. You will wind up killing yourself, quite literally. I can't even tell you. And the scariest part is I know that people are playing these options with leverage because the thrill or the allure of easy money, a quick win, big money, is very appealing. That is gambling. That is not what I do on my stream. That is not what I do for my personal money. That is not what I advise friends of mine to do. That is not what I advise anyone to do. That is a surefire way to destroy your account. So what is the better way to play with options? First and foremost is understanding the environment you're in. Like I said, understanding those Greeks. Knowing where the VIX is, for example, is very key. Let's start off with that because Vega, which is the last of the Greeks, which is kind of the forgotten Greek, and I'm not talking about the Street Fighter Vega, for those of you who know 90s gaming. Yep, we're talking Genesis. Anyway, or Super Nintendo or whatever you played back then. The move in Nintendo this week, by the way, has got me back into my old gaming ways. Anyway, Vega. So after a huge decline in the stock market, the VIX is sky high, right? So you think that you're going to play for a rebound. Buy calls, right? It's a risk-defined way. You'll be able to make a lot of money on a rebound. The chances are you'll be right, you'll get your direction right, and you'll wind up making no money. How is that possible? Because at any given point in time, one of those Greeks, and in this instance in a high VIX environment, the Vega is so blown out that any contraction in volatility, meaning the releasing of fear, meaning VIX collapse, will destroy the Vega component of your options. And just because you have a delta move, particularly if you're playing those out of the money, your Vega crush could be greater than the amount you make in direction. How to avoid that? Anybody? Spreads. Yes, your upside is limited, but as the vega gets crushed in the option that you're long, it also gets crushed in the option that you're short, giving you more of a pure delta play. Very simple. Spreads are your friend in that type of an environment. Conversely, the opposite is true. In a low VIX environment, when I'm talking about like your single digits or low double digit IV percentiles in options, you might want to just buy naked calls. Wait for the rally and then either collar it, you can turn it into a spread then. It's all a matter of where you are in the range. That is very, very important. If you take a look, by the way, I have on my weekend review videos VIX ranges where I think things are expensive and cheap. And where we are right now, by the way, this is pure naked speculation, meaning you want to be more of a buyer of premium here than a seller of premium. Because, like in my example, if you're long premium and the VIX explodes, you might not even have to have direction right, but your option could get so juiced that you either might not lose money or could make money on it, as crazy as that sounds. One of my favorite ways to play in options, I can't be more emphatic that if weekly premium isn't correct to buy, it is sure ripe to sell. Doesn't mean go out and be cavalier and technicals don't matter. We always are respecting technicals. We're always respecting market direction. We're always respecting if we're in a trend or in a flat market. I like to sell weekly premium to buy longer dated premium. So one of the examples that I like to do is I like to sell, for example, same week or next week puts if I'm betting on a stock going higher. And using that short dated where I have quick theta decay to buy longer dated premium. So a great example of that would be staying with Tesla. The other day, the play I think I have on is I bought the 230, 260 call spread. It's now 30 DTE. And I sold the 205, 9, at the time it was 10, but now 9 DTE puts. So that will offset some of the cost of those options. My thesis on that was, the technical thesis to get into the trade was the trend line break and the break of the range. The thesis behind the trade is that they don't report before the put expires, so I don't have earnings risk exposure for the down move, although maybe there will be trouble with the master plan release. That will be risk managed tomorrow, either up or down, whichever way the stock moves. It's not a really very big position, honestly, so it's not going to either make me rich or poor either way. Obviously, I hope it's going my direction, but the theory is that the call spread will hold its volatility and hold its premium while the short put decays quicker, so that I would be able to benefit from direction. And if the direction goes against me, as we move into the earnings, even if the move is down, those calls will hold their value longer, meaning they won't just kind of poof go into thin air. So the problem with the weeklies would be that they would just expire worthless and you'd lose 100% of the premium. With these longer dated ones, it's not going to be 100% loss. You at least can get some of the money back. That makes a really, really big difference over time. I assure you, you never want to have 100% losses. I don't want to mention any names, but I see a lot of people talk about, big game about buying out of the money premium. And they make a lot of money if it goes their way, and then you got to be prepared to kind of lose it all if it goes the wrong way. That's just not me. That will never be me. It's never been me. It's never been me. It's not me, and it never will be me. Let's keep it that simple. I like to sell the near dated to buy the longer dated. Buying the near dated is just pure gambling, pure speculation, and will end in the end very badly. That is my view. Yeah, exactly, pure gambling. If you're buying those out of the money, it can be true trouble. I also like to sell. My big thing is I like to sell out of the money puts. I've always liked that. It sort of fits my personality a little bit. Also, selling out of the money calls. I like to bet on what won't happen sometimes. You'll get nailed once in a while. On balance, if you do it correctly, you'll be okay. You have to look at IV, the implied volatility. In Thinkorswim, I really should be sending them a bill for promoting their platform, although they've been very good to me. They're really nice people over there. You can go into their today's options statistics, and you can see where the current IV percentile is. If that is below 50, you have no business selling any premium. The closer to 100 you get, the more rich they are, the more you want to be selling. You can also look at the absolute IV. For example, I'll use this in Apple because I know the stock exceptionally well. This is also something we're going to discuss in a moment, knowing stocks well or not. I know Apple. I know Apple's IV pretty much like the back of my hand. I know that when it's about 25, 26, that's about average for Apple, nothing special. I know that when it's in the 30s or in the low 40s, it is expensive and ripe to sell. Yeah, I mean, know your stocks, know your IV percentiles, know your absolute IVs on stocks. I always give the example of Hitch. I love that movie with Will Smith and the guy, I can't think of his name right offhand, but he was in that show, The King of Queens. And it's the dance scene, you know, when the guy wants to go all wild, and Will Smith tells him, just to stay within your kind of 6 inches or whatever. I like to stay in my 6 inches. I like to take a very narrow. Yes, Kevin James. There we go. That's why I love you guys. You always are there to pick me up when I stumble. Hopefully the same way that I'm there when you guys stumble as well. But yeah, he's telling Kevin James that stay within those inches. I like to take a narrow set of stocks that I know really well and follow them. I get to know their personalities. I know when they're acting well and when they're not acting properly. If something should be doing something and it's not, I know either to sidestep it or play against it. If something is acting properly, I know to stay with it. Once in a while, I'll step out if I see something that I think is promising, just based on pure technicals or fundamentals or something industry changing that I'm noticing. But for the most part, I stay within a very narrow band of stocks, and I play them based on technicals and a combination of fundamentals combined with macro, meaning where I see the overall direction of the market going and so on and so forth. So I think that just about covers the depth I want to go within options broadly. So I did a little teaser yesterday, and I'm going to give another real-world example of how I use options, and that would be with Facebook. So Facebook has probably been my favorite stock for the last couple of years. I hated it for the IPO. You can go back and check my Twitter stream. I basically told people to avoid it like the plague. Once it broke syndicate at 38, I knew that it wasn't going to be something that was attractive. When the stock got to about 20, I flipped bullish. The stock went still smidge lower to 19, but I've never really looked back other than tactically playing, trading around a core position and a thesis of long. I had always thought the stock would go to 100, 103. I talked about a channel. This is all documented in video and on tweets if anyone is a doubter. Very well established. So what do you do now with Facebook? It's at a new all-time high here. They are running into earnings. All right, so my theory is that I don't like stocks as much when they have earnings and they've run hard already into them. It's possible that you get that type of last exhaustion. My theory here is that I've been looking for is that I think Facebook is going to get to 128 to 130. Depends on your time frame, but that would be the 1.618 Fibonacci extension. I've talked for a while about a progression line, and if you go to earnings, that would be like smack into the progression line. Very simple. Ignore that line, by the way, at your own risk. It has proved time and time again to be a lot of trouble for the stock, and moves above it are unsustainable. However, if you're long shares, what's a good way to capture some of that upside, but maybe limit some of the downside on the shares and maybe make your shares work for you? A couple of the very simple ways with regard to Facebook right now, the IV percentile is really low. It's only 36%. It will probably rise as you go into earnings. I don't mind buying some put spreads. If you're sitting on big gains, if you don't mind about limiting some of your upside, you could sell some calls to buy put spreads or put flies. Very simple. Put spread, you buy a put and you sell a lower strike put. Very easy. And you would sell an out-of-the-money call, so you would benefit from a little bit of the upside if the stock went higher. You wouldn't necessarily benefit from the entire move, though, but you would get the difference between the current price, the price you sell, plus the premium you collect. Very great way to get in and out of stocks. Another way, if you want to be a little bit more, if you want to benefit from more of the upside, would be to do what I call a synthetic butterfly. Sounds very complicated, and it may even sound a little illicit at times, being the synthetic part of it, but it's actually very easy. You have your shares, you sell an upside call, you limit your upside on the shares. However, you will still benefit from the upside between the distance of the price and the distance of the call you sell, plus you would use some of the premium of the call you sell to buy a still further out-of-the-money upside call. If you do this with options, you basically have been buying a call, selling calls, and then buying further out-of-the-money calls. But since you own the stock, you don't need to buy the call. You would already be long based on your shares, selling out-of-the-money calls, and then buying the further out-of-the-money call. So you get stopped out basically at the call you're short, but you still have the call you're long to benefit from the further out-of-the-money. If you want to be really smarty pants, and this is frankly what I do, is I sell a near-dated call so that I'm benefiting from the higher IV percentile because it captures the earnings. And then the call that I buy, the longer dated one, is a further longer out-of-the-money call. So I'm paying a lower IV percentile, and I don't have as much theta decay. That is an amazing trade. So sometimes you'll get the pop, you'll be out of your shares because the call, you'll get it called away, but you'll still have a longer dated call. That can be used, if it does move your way, to sell a spread if it gets the move higher, to make it even a better play, or you can play with it to do all kinds of things at that point. But that is honestly one of the plays that I've used many times, very successfully actually, with Facebook. I think it was around this time, maybe a year or two, maybe it's 2 years ago already. Wow. I was in Puerto Rico and I was talking about a similar trade actually. Always try not to trade on vacation, but inevitably do. Anyway, that's one of the plays that I like. So either an outright call spread, buying an outright put spread, funded by a short call or not, or doing the synthetic play against your shares. The way I mentioned was to be long. If you're long the stock, you would sell an out-of-the-money call and then buy a still further out-of-the-money call. To enhance it and make it an even better play would be to sell a near-dated call that captures the juiced options. If you look at the IV percentiles next to the options, the IV next to the options. Let's pull up Facebook, for example. Next week, you got 49% IV. The expected move is $7.81 now. That's 9 days to expiration. If you use that premium, and let's say you go out to September, it's only 28% IV. And the move is expected to be 11 points. So those options aren't juiced that much at all. So you could sell, theoretically, if you go out 9 DTE, and let's just do it, right? We're here talking about it. Let's talk about selling the, let's say the 125s or the 128s. You could get currently, if the market's closed, but if you were to have sold today like on the close, you could sell the 125s for $2.41. I'd probably put that out there for $2.50. and that, or the 128s, you could get $1.32, for example, or $1.35 if you if you work it. If you went out to September, then you could buy, let's say, the 130. Could buy the one. Let's say you bought the 130s. Let's just say you did a straight out play. Those would be like less than $2. So you get most of that option. You basically get the premium for very little. Or you can buy the 135s, whatever. I would probably do the 130s though. So I like the idea of selling the near dated call and getting that upside call enhancement for very little in this instance. If you want to kind of lever, for those of you that want to lever your play, this is another one I was a little hesitant to discuss because of, I'll give you the caveat of why I don't necessarily like this. It sometimes is, after a big decline, is referred to as share repair, or in an upside market, share enhancement. The only problem I have with this is I've had these plays on before, and sometimes I get my move so fast that I'm hamstrung by the options play that I'm in. I've learned to just take the loss on the options and book it if this ever happens, meaning you get the move quicker than expected, and lock in the share price for a various number of reasons, because if the share price goes back on you, you could blow up your whole trade, and the amount you lose on the extra option is peanuts compared to what you've made on the overall trade. That's the caveat. So how do you do it? I love doing this, by the way, in weekly options, because you can get your move very quickly and you're not paying for it. So let's say you own shares. I'm going to use, let's just say 100 shares, keep it really, really basic. That's the minimum amount you can own to play with options as a covered position. And it's also going to be real easy for the ratio. So you own 100 shares and you want to benefit from some of the extra move. You want to enhance your move on Facebook, for example. So you go into Facebook options and you'd say, let's say 9 DCE. So what you would do is you would own your 100 shares and you would buy a call. So now you've turned your 100 share position into owning 100 shares and a call. But I don't really want to pay for that call, right? That's not how we roll. So what you would do, you're expecting an upside move, is you'd buy let's say a 125 call, and then you would sell 2 out of the money. Let's say, I want to just make sure that this is going to work. Let me just play with the ratio here to let you know what would work with that. 130, you're still paying for it. 128.9, you're still paying for it. 128, though, you get a credit, which is exactly where we want to be. So what you would do, let me see if I could play with this a little. No, it's got to be those. All right, so what you would do in this example, and this is in the 9 DTE, captures the earnings, is you would buy the 125 one time and sell 2 times out of the money the 128, which is where I see the resistance being. So you would benefit from that call spread on the 1-to-1 basis of 125 to 128, but you're using your shares as kind of your collateral for the extra call. So when you're buying the 1 call and you have the 100 shares, that's basically like the example of having 2 calls, except you really own it this time, and selling 2 times out of the money of the other calls to finance the purchase of the enhancement, the leverage on the one call. Is that clear? I know that's a little bit of a, and by the way, you're getting paid 24 cents to put that on. So that's a play I love to do. Usually when I'm expecting a move, but not necessarily right away. I was actually thinking about doing this with PayPal this week. That's been, by the way, a ginormous home run on that professional gap, which I discussed in the weekend review video. My problem is that I was looking for a bit of, although now I'm starting to think maybe even more. I'm starting to think maybe 44s or 46s in PayPal based on a channel that I drew in and a measured move that I took off of a last big decline to high. I also think if it gets through that 41.75, it's going to probably run quite a bit more, probably to a fib extension. But Short term, I was looking for a move to the 41s. I was thinking about either selling a call, making it a covered call, and taking that premium. But I thought that it was possible to get some kind of a quick pop given eBay's earnings were this week. And those stocks tend to kind of move a little bit together because of the nepotism that eBay was involved with. So I was a little worried that I would get my pop and then not be able to get out of the shares. So I opted not to do it. I may do it tomorrow, given that it's only 2 DTE. I'll post. I'll let you guys know what I decide to do, if anything. As of now, I think I have some sell orders into the 41s. I'd have to see where it is. But that trade has been just into some reference highs, just because it's moved so much so fast. So that's some of my options wizardry that I've learned to use over the years, and I hope that's really the right way to use options. So here's a quick question. I would love to post. I wish I was able. I should have thought to post this earlier, and seen what the results were. I'd be curious to see what people say. What's the proper way to use options for leverage or to increase your probability of success? I would love to see how people answer that. To increase your leverage and be able to use your money to play for more, or to limit your upside but to increase your probability of success. I'm very curious to see how people answer that. My answer to that would be to increase your probability of success. I know when you're, with smaller accounts, it's obviously most people do want to use it for leverage, but for me, I think it's the latter. You're basically able to increase your probabilities of success. A lot of people think options are very risky, and they can be if you don't know what you're doing. It's sort of like training. If you aren't trained to use that grenade launcher, you're going to wind up hurting yourself. But if you're a skilled professional in Delta Force, for example, you'll be, you'll use it to maximize, your bang for your buck. Yeah, I think we covered a lot of what I really set out to cover here with regard to options. Some of these are some very advanced topics. I hope that I explain them well. I don't necessarily, we'll see by the amount of questions I get based on it if I explain them well or not. But these are some stuff that I think you'll enjoy. This is probably not stuff you're going to hear on TV, but it will. I think you'll like it. With regard to some of the stocks, I think we've gone a while here already. I don't want to go too far over, but I'll cover my view on a couple of quick stocks. Let's start out with the S&P because that's really the most important one in my view here. We already talked about Facebook, where I think it could potentially go. SPY. All right, so SPY is starting to get some of my levels that I was looking for on the upside. Today had a little funny feel to it. It's a little nuanced. It was a breakout day, but it wasn't a real, true, traditional breakout day. It was a little bit of it had a poor high. This, believe it or not, day it didn't have quite the run into the close that we had on 6/23, the Brexit day, but it had a lot of that look and feel to it that we could have a bit of a liquidation break. If you're quick, if you want to be a Johnny on the spot trade, I like the idea of either a long above today's high or a short below the low for a quick trade. A liquidation break from here, if we were to take out today's low and then get through like 215.31, I think could see a retest of the breakout from the 213.78 to 212.52 area, potentially. Bigger picture, I'm still looking for the 1.618 fib extension, which is up around 221.09, and that's also, if it were to happen quick, would be up near the channel high. That's just we don't have any catalyst that I'm aware of really tomorrow. I'd have to, we don't have a Brexit vote. I don't think, by the way, a liquidation break that we would get from here would be nearly as dramatic as Brexit. That was a once-in-a-lifetime type of an opportunity. Anyone who recalls that day, I was saying book profits into the close and into that after hours pop. I thought the market was ripe for a liquidation break. I didn't realize it was going to be that big because, like everyone, I actually wanted Brexit. I was one of the few at the time. I also said on the decline it was a buyable decline because Brexit was a good thing, not a bad thing. Everyone thought I was crazy, and it wound up being correct. By the way, my thesis, but if we didn't have that Brexit, would be that we would have pinned 210 that week. So I think we would have opened high and spent the day selling off to 210. Where we went from there would have been a different story. We got the Brexit, no one was expecting it. It wound up being an even larger liquidation break. Believe it or not, that large liquidation break, I believe, is the reason we're at all-time highs. Sometimes the markets need to shake it out before it bakes it out. Shake and bake. It was just a really, really big one, a really, really big liquidation break. The characteristics of a bear market aren't 2 days down and then all-time highs, by the way. That just is not how it works. You recovered all of Brexit in 4 sessions. That's more characteristic of a bull market than it is of a bear market. All right, so Wednesday, I'm just looking at the calendar. You have some petroleum. That was today. Thursday. Tomorrow we have jobless claims at 8:30. That could be a catalyst for some moves. So 8:30. We also have Philly Fed at 8:30. Those are going to be really important. My big concern for the market and what I see as the big kind of boogeymen here are twofold. First and foremost, one is the dollar. That is just on a bit of a tear here. It had a multi-day consolidation that it broke out of yesterday and continued today. It did get to the 61.8 fib retracement, which was 97.27-ish. It needs to stop here. If it keeps going, we could be seeing a hundo again. I don't know when, but the market will not like that. I assure you. It's not a good thing. Strong dollar is no friend of S&P 500 earnings. The other cataclysm that we could have is that the Fed has been so badly priced out of the market that we could have what we had the last time around. I don't think the Fed should go. I don't know that they will go. I don't think they should go. I don't think that they will go because you had really bad data. You've now had a bit of an improvement in data, but it's really nothing to write home about. That big jobs number that everyone was excited about was really crapola jobs. They were waiters, waitresses, bartenders, and carnival ride operators. Those, geez, you'd think the way the market rallied that you bring someone home, you're excited to introduce your parents to your lawyer or doctor or someone with a good job, and the carnival ride operators are the new plastic surgeons. By the way the market's behaving. The fear I get is when you get unemployment and they're really good jobs. And you have a lot of wage increases. That is not what we're getting. There's no inflation fears in my view. The Fed should not be going. The data is junk. Really not good. Anyway, the fear is, of course, is that we overcompensate for that and that there's a bit of a pullback as people realize we have a Fed meeting, the market's at all-time highs, and you have idiots talking because they want to talk and make news, these Fed heads. So there could be a bit of an adjustment. That is a little bit of an issue for me. We are getting a pullback in the TLT. A measured move pullback would be to about 135.58 from the all-time highs. So we're getting kind of close. That's, believe it or not, almost about a 50% fib. I will be looking to kind of BTD somewhere between the 135s and more better, Mo Better, if you remember that movie with Damon Wayans, Mo Better Blues, would be 133.42. That is the 61.8 of the range. Somewhere in there, I think we'll likely find some buyers. That 61.8 too, 61.8 is very close to a gap fill, by the way, of the range, not necessarily the close of day. So somewhere in that area, I'll be looking to kind of BTD for a right or right out trade. Better still would be if it coincides with the 100-day moving average, which caught the last two lows. That's currently 132.38. It'll probably pull up somewhere around there. Size on the 100 MA for right or right out, meaning you want to be a big trade with a tight stop on the 100 MA. I like that, and I like it even more if it coincides with one of those Fibonacci levels when it gets there. So that's TLT. Those are the two big boogeymen for the market, though. The other less extent, it's sort of like the the IMP version. I guess I'm showing my Game of Thrones. I'm a Game of Thrones fan. The small man, the midget, Tyrion, the kind of, he's being the boogeyman here. Wow, that was really not politically correct, but I'm not really a PC type of guy. Anyway, the mini boogeyman is that the stocks run so hard, so high into their earnings that they become sell the news events. Be careful with that. Intel is getting a little bit of that in the after hours, that it just ran so much. Bigger picture, excuse me, it's a big W pattern. It probably could resolve higher, but short term it was way overbought. Yeah, all right, I'm just looking at some more of this stuff. Tesla, let's keep it simple. You have 2-day lows that are roughly the same. Anything below there is a stop out or a short. Anything above the 2-day highs is a long for a squeeze higher. Very simple. Keep it simple, stupid. Covered Intel, covered that. The VIX. So VIX, here's the story with VIX. You had a hammer today off of a test of the reference low. The last time we had that, we had a major blow up in terms of VIX. I would be more of a buyer of, like I said, of premium here than a seller. I don't necessarily know that you're going to get a complete explosion in the VIX here. There is something in mathematics known as a zero bound. VIX has an intrinsic value. Somewhere between 10 and 12 is usually the end of the move there. I think in 2007 you undercut it a little, and then we all know where that ended. That was like the top of the market. I'm not thinking anything like that right now, but I would be surprised if we don't see some type of a rebound in the VIX. Maybe you get a move back into like the 15s or something. There's a lot of moving averages around there. You have the 20, the 100, and the 50. So maybe that does coincide with a little bit of some pullback. I think the market really does need a little bit more consolidation. We did break the 4-day consolidation to up. We did have a poor high. It backed off a little. It didn't back off a lot, but we could still be if we're below the high of day today, there's still some vulnerability to liquidation breaks. So below today's low of day, I like a quick row short, and above the high of day, I like obviously playing to the long side. So that covers that. The VIX, by the way, could just chop around in this area. There's some intrinsic value. All right. Netflix, someone asked about Netflix. Let's keep it quick with Netflix. Above yesterday's high of day was a write or write out trade. I didn't take it. I wasn't involved with Netflix. 88.21 is the next big level I see here. We stalled a little bit and closed below there. I don't think it's possible Netflix fills the gap as long as you're over yesterday's high of day, which is 86.75. The trade, I guess, I'd rather be long than short. I just don't think that the worst of it is kind of over for Netflix. I don't know. I just had a feeling. Anyway, regardless, if you stay above that high of day, I think you could see 92, 93. If you get back into that range and below, I think it's going down to 80 and maybe even 70. Very simple. I'm just going to keep it at those levels. Above that high of day, long in the range, you don't want to be involved, and below, it's a short. All right, that's Netflix. Silver, someone asked me about silver. I took profits on silver. I was a little bit early on that. You're coming back down. The backside of the old channel, if it were to do it tomorrow, is like 18 and change. That would be good for an intraday day trade bounce. I really would love if this thing did something like pull back to a real fib of maybe get somewhere in the 16s or 17s. I think that would set up for a bit of a long. I'd probably sell some near dated out of the money puts there. I don't think this is coming right down to channel low anytime soon, back to 15s. So I'd be looking for something more mid-range. So like in the 16s or 17s, I think that's going to be the BTD area for a right or right out trade. Twitter, honestly, I don't even follow Twitter on a daily basis anymore. I'm long, it's rallying. It's sort of one of these things that it's just either, it's going to get higher or it's going to get lower. I have a little long. I don't follow it that much. They have earnings coming up. I don't love that it's rallied into earnings. They need 2 back-to-back quarters to really turn the page. They have been very, very slow to innovate. I like what they're doing with the NFL and with the NBA. They need to do more of that. they need to become more Instagram-like, in my view. I think if they can do something more Instagram-y and Snapchat-y and start getting not just news reporters and finance geeks involved with the platform, it will do well. It's just people don't understand how to use it. If you don't have a lot of followers, it doesn't really make a lot of sense. I don't know. They announced that they were going to they're going to take hashtags and URLs to stop character count. Why haven't they done that already? What is taking so long? It's just so annoying. Yeah, I don't know. I like Twitter. It's one of my, I think, my favorite form of social media. You know, I prefer to talk to people about stocks than look at pictures of their kids and their puppies. Just me, but that is what it is. Unfortunately, most of the world is more of the Kardashian education. I don't want to get sued, so I'm not going to talk any smack about them. But it's reality show people. You know, that's what people want to look at. Yeah, so that's Twitter. Oil. All right, this is another potential mini boogeyman out there, and we're going to end on this. It's just consolidating and pulling back. It really needs to hold. It's in a bit of a channel. There's some room down to like 42 half-ish. I think if it can hold between 45 and 42 half-ish, it's not going to be a big-time freak out. If we start getting below there in the 200 MA, we're going to have to revisit oil as a real problem. I think that we will see higher eventually, but look, the thing ran from 26 up to almost 52, which was my target. I said between 49 and 52, it got right there. Anything below 49 to me remains a little vulnerable. It's been pulling back in a controlled fashion. It's getting a little bit bombed out in the stochastics. It's first starting to get a bit bombed out in the stochastics. Yeah, I'm just gonna. Like I said, I'm looking to get back into oil. I'm just not quite ready yet. Exxon really got right up to close to the channel high. It's pulling back in a controlled fashion. That is that notable weakness in Exxon. You've now made a 52-week high and had 3 days that have been underperforming of the market. I think longer term Exxon wants to see a hundo, but I do think it could pull back. 50 MA-ish has been the good area. I like playing put ratios for a move down there, meaning buy a put and then selling out of the money puts near there, or buying those puts at the 50 and selling still further out if you're a little bit longer dated. I think that's the bit of a play. I've been looking to get back into selling more options and put premium in Exxon. But it's too cheap. The premium it's a joke at this point. I mean, everything's a joke because VIX is very low. I mean, the IV percentile in Exxon is 6. If you want to hedge your oil position, buy some put spreads. There you go. Very simple. Anyway, I think that's my story. I'm sticking to it. The sun is setting here and it's starting to get beating, and I'm going to get a tan. If you want to watch this video again, it's going to be on my YouTube channel very shortly. I'm going to post it right now, so it should be up there within the hour. That is Justin Pulitzer Trades at YouTube, on YouTube if you search me. If you're not following me on Twitter, my handle is @JustinPulitzer. My DMs are open to anybody, so if you don't send me profanity or pornography, you'll get a response. Very simple. Yeah. Anyway, that's my story. I'm sticking to it. Let's have a great rest of our week, and cheers.